Good afternoon. Thank you for joining us today for our Power of Capital webinar featuring JP Morgan Chase. My name is Sonia Bigelow Smith, and I am the director of the Capital Readiness Program, powered by the Minority Business Development Agency and operated by the Capital Region Minority Supplier Development Council under the leadership of Sharon Pender, President and CEO. The Capital Readiness Grant was awarded to our organization a little over 6 months ago, charging us to offer relevant and valuable financial knowledge and education in an effort to connect more underserved owners to the much needed capital to sustain, start, grow, or scale their businesses. We are in service and committed to this work. As many of you may be well aware, that there are significant barriers that exist for businesses to achieve their financial goals. Webinars and programs like these will continue to be offered to help with the proper preparation to secure capital. And we are working very closely with our ecosystem of strategic partners to offer a variety of lending options for you. One of those partners is JP Morgan Chase. And I have the great pleasure of welcoming Christina Sicard for today's presentation. But let me share a little bit about her background. Christina Sicard is the Vice President, Banking Advisor, and Business Consultant focused on diverse businesses at JP Morgan Chase. She has over 12 years of experience in financial services and expertise in commercial lending, financial analysis, and relationship management, which enables her to provide laser-focused one-on-one consultative services to businesses. She has been recognized as one of the top outstanding performers and national achievers in the country for, I repeat, 4 years consecutively across both New York and the DMV markets, a distinction held for the top 1% of bankers at the firm. Her approach is very client-centric, which is why we invited her, and know that you will enjoy this presentation today. Welcome, Christina. How are you doing today?
I am doing so well. Thank you so much for having me. I'm so excited, Sonia, to do this presentation and to work with your clients and talk more about the work we're doing at JP Morgan.
All right. Well, Christina, I'm going to turn it over to you. I will be back at the end to connect with everyone, but thank you a lot, and we'll turn it over to you. Thank you.
Great, great, great. So I'm going to try to keep this as energized as possible as we go through this. It's not interactive, but hopefully it's going to be impactful and everyone's going to gather some really great information. And so a lot of what we're doing today is because we want to make sure that we can work with a lot of business owners that have been underserved in the marketplace and create an economic system that is going to be forward thinking and, inclusive of everyone and give everybody an opportunity to challenge themselves. And I've met a lot of business owners in the past, and some of the things that I've heard, especially for some successful women-owned business owners recently, that have been in business for about 10 years or so, who have bootstrapped their own way into multi-million dollar revenue generating companies. And they did it because they might have received a no early on when they went to a bank or to a lender to get access to capital. And so from that one experience, they kind of turned their back on conventional opportunities to get access to capital and just bootstrap their way to success. And while I love that idea, the goal here is to see how can we make people more comfortable, help them build better relationships with their financial partners, i.e. the bank, and find ways to get to yes, even if they've received a no. And so that's what we're doing today. So Reggie's going to help me move along through our presentation and through our slides as we go on. And so as we move to the next slide, a lot of what we realized during coronavirus is that it was an unprecedented, challenging time, and a lot of people had to pivot. What I did notice is some businesses did not have more than 15 days of runway, meaning their cash flow did not carry them past 2 weeks of expenses to hold them down while they were, experiencing some of these challenges. And so a lot of the things that we're going to talk about today are going to be solid foundational skills that and things that businesses can do so that you can be prepared in the event that something like coronavirus happens, and you have a way to pivot, and you also have more of a runway to give yourself a cushion in the event that something like that happens again. And it won't look like coronavirus. It might not be coronavirus, but I will guarantee there are always going to be life-changing situations that can occur. And we don't know what that is going to look like, but we know that if you have some of these fundamentals at play, that you'll be able to sustain. So a lot of what we've seen during some of the surveys that we've done, and Reggie's, we move to the next slide, is 39% of business owners feel that they don't get the necessary respect that they deserve from their banking institution. Um, or that they are getting that respect. And so what I noticed that means is that at least 60% or more people don't feel comfortable with the relationships they have. And that's something that we want to change. And we want to find a way to make sure that we are promoting building relationships. I find that just like you have a primary care doctor, you should have a banker that you work with that is your advocate and someone that you are going to have a long-standing day-to-day relationship with and do work with. So next slide. The banking industry, like I mentioned before, we're looking at different insights and different ways that we can help people be prepared for opportunities that are going to come their way. And so a lot of the different perspectives and things that you'll see to hear today are going to be things that you can work on and try to build the momentum. And so while you might not have everything in place today, this is going to be an opportunity for you to get to a working place and to further yourself as you move on. So Reggie, next slide. And we're going to move fast here. But before we get into the agenda of what we're going to cover today, I want to bring up a poll, and I want to see how many people feel really comfortable with credit, right? And I want to kind of gauge the room and get an idea. So how confident are you? Not confident at all. I know a little bit. I'm ready to dig a little deeper. I have a solid base of knowledge, or I'm very confident. And this way I can read the room and understand where everyone is and get an idea of, where we should focus. So I'll give everyone a little minute to fill out the poll questions and see what we came up with. Is everyone voting? Reggie, I'm sure you'll let me know when we have some numbers that I can. Okay, so we have about 16 out of 28. And where are we going to see exactly what the numbers say? Looks like we're going to have the results coming in now. So we have 33% not confident at all. Okay. We have 14%. We have a tie. So 14%, I know a little. I'm ready to dig a little deeper. And another tie, 33% at I have a solid base of knowledge, and 5% I am very confident. Okay, I like the room. We had some ties here, and so it's going to be really interesting as we move along. And we do have a chat below for questions, and we'll try to address some of those towards the end. And if I catch some as we're going through, I'll also see if I can answer some as well. So what we're going to cover today is we're going to talk strategically about cash flow and what that really means. Does your business need to borrow? This is where we're going to hold the mirror up and you're going to look into it and you're going to say, is this something I need to do? And if so, why am I going to do it? And then secondly, why are you a good investment? Why should a bank or a lender, extend you credit, right? And give you this credit facility? What is the financial data that's going to be really important? What are some of the different credit options out there, as well as some of the different programs? And then let's get started on building that empire of yours. So as we move on to the next and first segment about cash flow, a lot of people think cash flow is the money that they have in the bank. And it's really not, right? Cash flow is more about like where you are in terms of after you've paid all of your, expenses and everything has gone out. So when you think about cash flow, it's about what flexibility do you have once your revenue has generated, income has come in, your clients have paid you, all of your expenses have gone out. So it could be paying your supplies, your rent, it could be reinvesting in the business, buying more goods and services. And so once that's done, what do you have left over? Is there an excess in terms of, let's say there's a really good opportunity for you to buy some additional products, right? Or maybe do you have money to reinvest into research and development? So maybe you can create another product in your line of that you're offering. Or maybe can you bring in a consultant that can help you with how to develop some additional income streams for your business? Whatever that might be, cash flow is what you're going to have after all is said and done in your cycle of business, meaning money that's come in and money that's gone out. Right. And so a lot of times, a lot of people will think about, well, if I have, $100,000 in the bank today, that's going to make it me a good credit, that'll make me a good person to achieve, credit opportunities, or a bank should lend to me. And I'll often say, well, you have $100,000 today, but what guarantee do I have that $100,000 is going to be there tomorrow? And so as we go further on into the presentation, we're going to look at what banks are really looking at when they talk about cash flow. And so we're going to send out some workbooks a little bit later on that are going to go into some of these topics a lot deeper. And they're going to give you some time to actually write down your thoughts and where you stand with your business and look into some of these scenarios that they've come up with. But one that they came up with is Tiffany, who has an IT firm. And I'll give you a really quick synopsis of what it's about. So basically, think about an IT firm doing really well. She has several contracts. Things have been panning out pretty well for her. And she's done a lot of these services already for some of these government agencies. Now, the government agencies are going to pay her either in a net 30, meaning 30 days from today, or 45 days from today. But she's already provided them the services, so she has accounts receivables. So now what happens is she's spending money while she's waiting for the money to come in. She's treating her employees out to dinners to thank them for the work they've done. She's paying her normal bills, rent, expenses, updating some of her software and technology so that she can achieve the goals that she needs to achieve for this IT solution that she's providing. And she's spending a lot of money, but guess what happened? She negated to send out any invoices to these government entities, right? So now, guess what happens? She's got all this money that's gone out for expenses and payroll, thinking she'll be paid in 30 and 45 days. Meanwhile, she hasn't even sent the invoices out. So now let's figure it out. By the time she sends out the invoices, she now has to add another additional, maybe at bare minimum 60 days for payment, because the vendor has 30 days from when they receive the invoice to pay her, or 45 days to pay her. So something like this can actually crush a company, because now instead of waiting maybe 45 days, she might be anywhere from 90 to 120 days out before she receives any payments, which means that she might have to sustain and float all of her bills until that period of time. And so this is what we're talking about with cash flow. And basically, if you don't pay attention to not only the work you're doing, but the back end, meaning the receivables, the money coming in, and make sure that you have a cycle that is working well and well-rounded, those are the things that can make or break a business. Because remember when I started in the beginning and I said the average business only had about 15 days of runway during that period of COVID when everything was shut down. So now a manager, we're talking about 120 days. So just a little thought for you in terms of looking at this situation and understanding more about cash flow troubles and things that you need to think about in terms of how you can manage these periods of time where you have a lot of money out and waiting on money to come in. So as we move on from here, again, a lot of what I already mentioned. So managing your cash flow is important. The payables and receivables, really important. If this is something you can't handle, you may want to think about having an assistant, or, there's virtual assistants. I always tell people there's a lot of opportunities for you to bring people in, interns. Maybe you don't have money to spend on an additional body, but maybe you can go to your local business school, or a lot of schools have incubators or business, or you can find someone who's specializing in an industry, your industry, and they're doing classes and they want to intern and learn more from someone like yourself. And maybe they can come in and help you manage some of these things on the back end. But you have to have a good process around managing these things, because it is very important that you have cash flow on hand or find ways to bridge yourself during that time. And bridging yourself could mean borrowing capital. So as we go, how do you know if you need to borrow, right? Does your business really, can you accommodate a loan facility? So everywhere on YouTube, I see a lot of people saying, hey, we can get you capital. We can get you $50,000 here, $50,000 there, $200,000 here. But guess what? Once you've gotten all this capital, I don't see anyone talking about how do you generate revenue to pay back all of this money you've taken out. There's going to be consequences for the money that you receive. A lot of people are looking for money without any personal guarantees, and that's few and far in between. So what you need to understand is when you're going to take out capital, most of the time, they're going to be looking for you, the business owner, to personally guarantee the loan or the funding. And so you need to make sure you have a way to pay back the funds and that it fits into your budget, right? Do you have enough cash flow once you've looked at your year-end statements from the previous year and you do your analysis and you've paid all of your taxes and you've done all of the financial calculations you can, do you have the money and the profitability to be able to pay back those funds? And so one of the things you really need to think about. So, what do we want to know when you come to us? How long have you been in business? Now, typically, if you've only been in business for less than 2 years, it's going to be pretty difficult to get conventional lending, right? Because you don't have any historical data to really have proof of concept that your business is going to be profitable and that you are going to make money. So, these are some of the times where I say, sometimes it's beneficial to keep your job if you have a job while you're working on getting your business started. A lot of times it's great to come up with a month over month forecast of your expenses and what they're going to look like. What is it going to take you on every month to produce your product, to get your service out, to market, to obtain your clientele, your cost of acquisition, everything. How much does it cost in terms of shipping if you're doing a manual product that you have to ship out? If you're going to be doing consulting services, do you have programming or software that you need to manage this? Everything that you need to do in terms of your expenses. And then you need to figure out, okay, I'm going to have X amount of clients, and these clients are going to pay me X amount of dollars. And at the end of the month, you need to have a budget of, this is how much I need to cover myself. You also need to live. You have your house payments that need to be made, or car payments, or groceries to keep yourself filled. And you should come up with a budget for at least a year. And then you should try to find a way to finance that budget and come up with funding. And whether that's going to friends and family and looking for a loan, there's crowdfunding opportunities, whatever it might look like. But I wouldn't be dependent on just specifically getting a loan, quitting my job. I'm going to start this business and I'm going to walk into a bank and they're going to give me money to start up this business. It doesn't necessarily work like that. And so you need to have a plan of action, right? So, number one, how long have you been in business? Now, if you've been in business for at least 2 years, is that business profitable? Are you showing proper cash flow? Back to what I spoke about in the beginning. You have all of this cash flow coming in, you have expenses going out. Are you showing positive net income at the end of the year, or are you showing negative cash flow? Negative cash flow is assigned to a bank that you may not be able to repay the loan that they have set forth with you, right? So you want to make sure that you're going to be profitable. And a lot of times, this is having a great conversation with your accountant or CPA, because what's their job? Their job is to save you money on taxes historically, right? If your CPA has done a really good job with providing you services, they feel that they've helped you save on your tax bill. And usually to do that, they'll write off different expenses. Well, guess what? You need to make sure that you have this conversation that, hey, I need to be lendable, bankable, and I want to access funds from a financial institution as soon as I can. And this way, I need to show up as profitable. So you need to be very cognizant about your cash flow and what that looks like and how you're showing up on paper. Third thing, is your business seasonal? So, what does that mean? If you're in the landscaping business and you work in the Northeast, and let's say come wintertime, it's pretty slow. It hasn't been snowing much lately. So, a lot of times, landscapers are not making as much money in the winter months as they are in the summer months. Or if you've ever seen that show, Queen Sugar, I used to watch it, where 2 weeks of a harvested crop will cover a year's worth of payroll and expenses for a farm, right? But before that harvest, is ready, there's an entire year that goes by that has to go into plantings, watering or fertilizing or whatever goes into that process. And farmers need funding for that piece of it. And so understanding if your business is seasonal and then being able to communicate that to your lender and show them the numbers and to understand that this is why you'll need additional funding to cover you during these moments while you're waiting for this point of time where your sales are going to be driven up because it's a cyclical business. If you have an Rita's or an ice cream shop where, yes, year round people might buy, but you're going to find in the summer months, that's going to be your big drivers of revenue when it's hot and people are, buying a lot more than they typically would in the colder months. And so a lot of understanding your business and what your needs are figuring out, is your business seasonal? And this could be a good time and a good reason why you could be a good bet for a lender to lend money to. So secondly, do you need to build credit? In building credit, a lot of times you need to start off small. And then once you can show that you have a line of credit or business credit card that you've used a small amount, then you can prepare yourself to get access to larger lines or larger credit facilities because lenders will see that you have a history of payment. So one of the things that people don't realize is also how important personal credit is to this equation. Personal credit, especially in the beginning, is going to be something that's going to carry the business because when you don't have any credit history for the business, you're just getting started. A business credit card is a really wonderful way to manage cash flow because you can use it, especially if there's, let's say, a 0% interest card that you can benefit from and have access to capital, and then use that while you're waiting for more clients to come in or client payments to come in, and you can use it to float a lot of expenses. Some landlords are taking credit cards these days, and there's so many things you can do. Buy your products, use it for marketing dollars, whatever. I mean, the only thing I don't think you can use it for is payroll. And someone literally told me the other day, like, yeah, there's some payroll companies that are taking credit card. Do not quote me on that. I heard that out in the marketplace, but I haven't seen it personally. And I used to work for a payroll company, both ADP and Paychecks, years before I worked at Chase. And I don't know that to be true, but I wouldn't be surprised because that's just how beneficial and how much credit is being extended through card these days. And I think, a lot of vendors out there realize that and realize this is a way to utilize card. So you need to be cognizant and always, careful in how you're using it and managing your credit. Again, even if it's a credit card, you need to be sure that you can pay those funds back and that you can pay them down, because when you do get a 0% interest for 18, 12 months, 18 months, whatever it might be, you still need to pay a minimum payment, which is usually about 1% of whatever the bill is. And then you also need to realize that once that term is over, now that credit card is going to go up to maybe 20%. Rates are high. We're in a much higher in rate, environment than we have been historically. And so you need to be cognizant of the cost of money these days. It is a little bit different. So again, having a plan, but make sure you're building those credits so that you can qualify for the larger loans. You have to, crawl before you walk. That's what we tell kids. And it's kind of similar to credit. You got to start somewhere and then you continue to move up. And then once you've, satisfied one opportunity, then, a new opportunity can open and expand. So expansion, right? This is something that can be really helpful. If you have a successful business, you're doing really well. Would a second location help you? Would expanding into another market continue to bring you more revenue? These are all reasons to lend, to find, lending opportunities. And these are all things that lenders would want to know to understand, okay, where do you see the vision? What is this going to do? Me extending this, what do you perceive is going to happen in the event that you add this additional line of business, this additional revenue stream. It could be add additional people so that you can gain more contracts or satisfy larger contracts. You need to kind of be able to articulate what is it this is going to do for me and how is this money going to get me to the next level. Same thing with equipment, right? I could be, by me adding this equipment, I'm going to cut down production costs because I've been outsourcing it. And now I'll be able to do it in-house, or maybe I'm able to do something additional that I wasn't able to do in the past, which adds another level of income stream for me. These are all the things we want to know about and learn about in terms of what lenders want to know if you're going to be, a good risk. So a lot of things to think about here. So credit, a lot of times people take credit into different contexts. The context that we're going to talk about credit here is the agreement between the borrower and the lender, which is very important. I had a conversation with a client yesterday, and it was not the easiest conversation to have. However, a lot of times we go into things, and we're going to talk about the different types of credit. But one of the things that we discussed are the agreement. The client has a line of credit, and understanding the difference between a line of credit and a term loan is very important. So a line of credit is meant for short-term uses. And Reggie, I know I'm probably getting ahead of myself, so we can probably move on to the next slide. This is some information that you'll find into your workbook once you get it. Go in, definitely look at some of this stuff in your environment and kind of do some of these worksheets. But we're going to move on, just, for time sake. But definitely go back and, look at some of these things and fill that out into your workbook. But again, why are you a good investment? This is going to go big into understanding more about this conversation I had with a client that was kind of uncomfortable, and understanding, the differences between the different types of credit agreements and why it's really important. And so before we get there, just understanding, why are you a good investment? Number one is basically, like I mentioned, kind of understanding and being able to articulate why your business is going to be a good leader, why your business is going to do well. What is your previous experience, right? Do you have management experience? Is this something you've done in the past, for another company, and you have a level of expertise that you've developed? What are some different ways that you can show that, okay, this is why my business is going to be a good investment? And when we're thinking about investment, it's not only lenders, right? There's other opportunities to gain funding. So it could be, if you're looking at an angel investor, venture capital, everybody wants to know why they should invest into your business. And so when you go into these conversations, these need to be the things that you kind of discuss and understand, and kind of have set speaking points as to why you're going to be the one that, we should take a chance on. So as we move on, Reggie, next slide. Some things you want to look at: leadership, right? So it could be you have the right network, you have the right key people working for you. Maybe you've had 20 years in this industry doing this for another company, and now you're going out on your own. There's a lot of reasons why you could be the person, your business is going to be a good opportunity. But this is also something to think about. If you don't have any experience, you need to think about this going in, because if you're in the early stages, and this is more for the early stages folks who have maybe 3 years in business, 2 years in business, they're really kind of getting started. If you don't have experience in this industry, you need to think about how you're going to mitigate that question, because they're going to ask you, well, why do you think this would be good? Let's say you're an IT consultant, but now you want to open a bakery. I mean, how does that translate, right? Those skills in IT, how does that translate to the bakery? But then you could say, well, I've hired someone that recently sold a bakery, and they're going to stay on and manage this bakery for me and take it, use some of the concepts from their previous work and be able to help me navigate the space, right? What is the reason? So you want to think about that. The cash flow, again, what does the bottom line look at? Your net income, right? A lot of times people look at, EBITDA as a good way to understand the business. If you're looking to sell your business, that's where they're going to base your valuation off of. But for me, I want to look at your net income, right? What do you have after you know, all of the money's been taken out, all of the different ad backs have been put into place, and that's going to let us know exactly where you stand and what you can afford. And then collateral. Do you have other aspects and assets or things that are going to be helpful, right? So that, I don't think any bank wants to go and take your, real estate or, take your assets from you, but it is good to know that you do have some assets that are going to be okay if in fact you do default on the loan. And, we do need to have some type of assets to regain our money back. Because again, everything is about how are you going to repay the terms of the loan. That's really all any of this is about. So as we move on, like I mentioned earlier, your personal credit score is going to be a big factor. A lot of times people think that they can open up the business, get an EIN number, and it kind of erases everything to do with their personal. And that could be further from the truth. So I would, encourage you to pull your credit report. You can go to freeannualcreditreport.com. And what that's going to do is allow you to see where you stand and then look at ways to try to fix it. Whether it's you have collections on there, or some late payments, you want to try to get on automatic payments for everything. One late payment within a 12-year window can take you to an automatic decline on a credit application. And a lot of people don't realize that, how the importance of late payments and what the impact is. And so the easy way to avoid that is to automate all your payments. If you do not have automatic payments set up today, it is the one thing, if you don't walk away from this this webinar with any other, jewel or any other message, is to put everything on automatic payment, and don't be the person that is hesitant to do it. And then one late payment puts you in a bad predicament, because a lot of times the other thing is, start dating your bankers and figuring out what you need. Don't wait until you need money to start going and looking about asking for money, because that's the worst time to do it. You want to look for money when you don't need it and understand what needs to happen. That way, if you need to take certain steps, if you need to make certain tweaks, you have time and you're not up against the wall, in a life or death situation, because you have this opportunity in front of you, but you don't have the capital um to accomplish it or to move forward. So your personal credit score, like I mentioned, freeannualcreditreport.com. You'll want to take a look at that. And then again, set up automated payments so that you're not missing anything. And then we also look at business credit. A lot of these credit bureaus offer you an opportunity to look at the business credit. We also look at the Small Business Financial Exchange to look at business credit as well. And so again, if you don't have a lot of business credit. The personal credit is going to be your gateway in the beginning. But once you get to, I've seen, multi-million dollar companies, I'm talking 15, $18 million in revenue, and banks still ask them for personal guarantees, right? So this idea that there's going to be funding out there and you don't have to ever use your personal credit is kind of a bigger fallacy than people might think. And if you do get this type of funding, it's going to cost you more, because usually the further you get away from, the easier it is, meaning less work, less credit, less personal, liability. All of these things cost extra. So yes, there's going to be a lender that will offer that to you, but usually it's going to be at a premium cost. So what's the point of that? I tell people, just get yourself into the right situation. And yes, that might include paying a little bit more taxes, but I do feel that when I see clients who turn the corner on the thought process of writing everything off and showing more profitability and maybe paying a little bit more in taxes, what I do see in the end result is a lot more doors open up for them, because they have access to capital and opportunities that allow them to do more in terms of revenue and bringing in other business. The other way to offset that is to look at other options around investing, retirement, right? I think the one thing we don't talk about is look at ways to put money away. If you have a SEP IRA, you can put it over up to like $60,000 tax deferred into an IRA, a SEP IRA. You can look at other opportunities to invest where you're not necessarily writing off capital, but you are lowering your tax liability. So, some things to talk about. So, what financial data is important? So, the number one thing that people don't realize, that I guess people think don't realize is important, or don't realize that loan officers are going to want to see, are your business tax returns, right? So, a lot of times I have people who say, my tax returns are not done, they're on extension, whatever the case may be. And I understand that. And I say, but how did you do last year? Well, last year was my best year. And I say, okay, understood. And so while I understand that you want to maybe hold off on the tax payment, or, you have that extension filed, I would say that I would encourage you to get that done a lot earlier, because if your best year was last year and you're going to wait until the end of 2024 to file your tax returns, then everything you do is going to kind of be based on your 2020, two returns, which might have been significantly lower than what you did last year. And so you have to look at the give the pros and the cons of that, right? You're, saving on your taxes, but look at all the money that you're now having to discount because you haven't done those financials. And so a lot of times, yes, you can submit year-to-date income statements and year-to-date balance sheets, which we'll talk more about that. But those things are not going to be as as telling as your final business returns, audited business returns that have been done and sent in. And so those are the things that you're going to need to measure, right? So your balance sheet, basically, it's going to be a statement of your assets and liabilities and the capital of your business, and kind of give you a detailed breakdown of your income and your expenditures, right? And so a lot of times, and these are for my more mature companies, this is where a lot of things are going to come into play. So in addition to the tax return, they are going to be looking at these documents as well. but what they're going to gather from them are things like your leverage ratio. This is going to be a comparison of how much you owe, and how much equity and capital you have in your business. So basically, it's looking at if your business owes a lot of money compared to the overall value, that means that you're highly leveraged, then you could be a risky play. So basically, the lower your leverage ratio is, the better, you look on paper to a bank, right? And so in order to look at your leverage ratio, what they're doing is they're taking your total liabilities and they're dividing that by your total shareholders' equity. And so less than one is good. The lower the number, the better. So just to kind of reiterate that, and you can look this up and it's going to be in your workbook as well, right? So what do? Google is my best friend. You can go in and say, what is the leverage ratio? But basically it's, your debt to equity ratio. And basically it's going to be your liabilities divided by your shareholders' equity again. And then that's going to tell us, how much, is this person over leveraged? Do they have a lot of debt? Do they have value in the company? So just want you to kind of be cognizant of that as you're going through and looking at some of these things, right? So the next thing is going to be your current ratio, right? That's going to be a measurement of your company's ability to pay short-term obligations, things that are coming up like within the next year. So your credit cards, maybe a small loan that you took out that's going to be, need to be paid back. Maybe you have a seller's note, something of that nature. And so in general, the higher this number is, the more confident the lenders in your ability to pay back funding, right? So in order to look at the current ratio, you're going to be looking at current assets divided by your current liabilities, right? So if the ratio is higher than one, it's great. If the ratio is one, that's just enough to pay back your liabilities. And if it's less than one, it's kind of going to be alarming and say you might not have enough, right? And so again, your current assets divided by your current liabilities. So one of the ratios that we look at when we're calculating loans and lines of credit and whether you can pay is your debt service ratio, right? So for the debt service ratio, we have the amount that you're looking to borrow, whatever that is, if it's 200,000, 500,000, 100,000, there's going to be a debt service equated to that loan, line of credit, the building you bought, whatever it might be for the year, right? And we're going to come up with what that debt service is you need to cover on that amount of funding. So once we figure out that amount of funding, we're going to take that debt service and we're going to take your net income, and your net income is going to be divided by that debt service, and it's going to give us a ratio, which is the debt service coverage. And so we want to see for every dollar we lend that you have 1.2 to pay back. So again, this starts to become a numbers game as you get into it. And this is a lot of the work that we do, or your banker should be able to help you do as you start to understand the lending environment and where you fit into it. And a lot of these more deeper analysis are going to come into play, especially for the more mature clients that are looking for, larger amounts. When you're talking about, maybe $100,000 or less, a lot of times then they may not look at, as deep, sometimes they may look at credit, and that could be a potential. If you're a customer of the bank and you've been in business for a few years, but the larger the loan, the more that we start to look at some of these things in tandem with your business tax returns. We're looking at the balance sheet. We're looking at the profit and loss statement so that we can understand how healthy is the company in terms of repayment. Okay. And so as we these are just some areas that we focus on and that we look at when we're doing some of these evaluations. And like I mentioned, you should start having these conversations early on before you even need access to the capital. And don't wait until you don't want to wait until, that the immediate need is on the table, and now you have to kind of figure out what it is that you need to have in place in order to move forward. And so before we move on into there, just a couple of, into what the credit options are, just a couple of other things I wanted to discuss. We're gonna look at things like your gross profit margin. That's gonna talk about the profitability in terms of the percentage of revenue exceeding your cost of goods, right? So if you have, a high profit margin and the percentages are going up, that's gonna be an indicator that you're gonna be, likely able to do repayment. So we're looking at year over year numbers, right? If that number goes down from the previous year, you need to be able to mitigate these things, right? So just as good as when you have a great story to tell, if something happened in that year, let's say you were doing some additional research and development, and it forced you to incur some additional um, expenses around creating a new product line, bringing in a new employee, whatever it might be. But you want to speak to these things if there's a change and the numbers shift downward, right? So it's not only about talking about if the number shift upward, that's great. If the number shifts downward, you want to be able to explain and mitigate those reasons. So just think about that as well. So then there's things like SG&A to sales. This is going to be a comparison of your sales revenue to selling, general and administrative expenses. So this takes out the cost of producing and shipping products and focuses on the spending that was required for you to make a sale. And so what does that mean? Your customer acquisition costs. You hear that number a lot. And so you need to kind of understand what that means, right? What is it? How much is it costing you to get a product to or service to market? And if there's a sales slump, or a lot of people have been infected with inflation and find that sales are down a little bit, then if you have a high customer acquisition number, then that's going to really be difficult in terms of you keeping up with your revenue. So some things to just kind of understand and to think about as you're going into what some of the lenders are looking at in terms of analyzing your business and also figuring out where you stand. So I would encourage you, again, as you go into the workbook, look at some of these definitions. You can Google it. You can go to ChatGPT. That's my best friend. And they will give you a lot of information, and then you can pull these documents. And so if you have QuickBooks, you should be able to pull your balance sheet. If you have, again, QuickBooks, your income statement, you can pull these numbers. You should have your business tax returns, and you can start to analyze some of these things. And if it's too much, then you should be sitting down with your banker or building a relationship. If you don't have a banker, you should be interviewing and finding that person that can kind of act as your doctor. So we talked about EBITDA, that's your earnings before interest, taxes, depreciation, and amortization. It kind of shows your earnings before any deductions have been taken out, as well as any add backs, meaning you can add back things like interest and depreciation to your net income. after, some of the deductions have been taken. But this is just a kind of way for a bank or a lender or even a prospect looking to purchase your company will kind of understand the value of the company, and understand your business cash flow. So just to be clear, again, uh, your business tax returns, the P&L statement or income statement, same thing, balance sheet. These are the things that folks are going to really want to see. They might also want to see a personal financial statement. The larger the loans, these are non-negotiables usually in terms of a financial package. And so you need to start getting yourself acclimated with these things if you're not on these documents, and start looking at them. And if you don't have the right accountant or the right banker, then maybe you should be looking to see if they can help you figure some of these things out. And if they're not, then you want to maybe think about it. So really quick, we're going to go into what are your credit options. The first, we kind of spoke about it, was credit card. I think we kind of covered that. They're really helpful. You can use them to get rewards. I think a lot of times for me, I'm more interested in the 0%, especially if you're having a cash flow crunch. That's, I think, really helpful. The rewards are great. A lot of times people have points and they don't even know it. I had a client, they had like 1,000,000 points, which is like, which is a ton of money, but a lot of people don't even realize. And some cards, you can use the rewards and turn them into cash dollars. So a lot of people don't realize like 100,000 points is $1,000. And then if you use it to buy certain things, depending on the site, it could be multiplied and it could become 1,250. So imagine, 1,000,000, that's a lot of points. You're talking like, $10,000 there. So um the next thing is, and it's a great starting point if you haven't had any credit or if you're in the startup phase, that's where I really, encourage folks to go and take advantage. So back to this situation I had with a client yesterday. The business line of credit is for short-term options. It's usually best for people who have accounts receivables, meaning they have funds coming in, but they just need cash flow for a short period of time because they know that they're going to bring in additional funds in the next 30, 60, 90 days. So the agreement is you have a line of credit. If I give you a line of credit and you max it out, then you need to be paying it down several times a year. The idea is you're going to use it, you're going to pay it back, you're going to use it, you're going to pay it back. I tell people this all the time. And then so I found myself in a situation where a client has maxed out their line of credit, and they're like, well, I thought as long as I make my minimum payments, I'm fine. I said, no, that's not the agreement. The agreement is that you're going to use it for short-term purposes. So carrying a full use for an entire year and you've maxed out your line of credit and you only pay the minimum payment, the one thing that can happen is I've seen them convert it into a loan and end it. And now the client had to go, that I had in the past, had to pay principal plus interest. And it went from being a small amount, maybe he was paying, I think, I don't know, maybe $800 in interest to something like $4,000 a month. And so the credit agreement is really important. If you are not in a business where you have, that you're going to be getting lump sums of funds for services you've provided, i.e., if you're a restaurant and you don't have catering contracts, or you're in a retail business and you make money as clients come in and you don't have any outstanding receivables coming to you, this is not the right product. You need to think about product selection, because again, if you pick the line of credit and the credit agreement is for short-term uses and now you max it out and you don't pay it down in the way that, a few times a year, it's okay to max it out, but that's because I have $50,000 coming in 30 days and I'm going to pay it right back to the line of credit. That's how it should be used. Then this is not the product. What you want is the next one, which is a term loan. This is going to be for larger purchases. This is going to be for expended time. This is when you don't have a prediction of when you'll be able to pay the funding back. And so therefore you're going to get on a schedule, and that's the funds that you're going to use. So this is what you want to do. This is the difference between the line of credit and the loan. This is better for businesses that don't have long, funding that's going to be coming in later. So we're going to extend you this product. It's matching the right product with your industry and the way your cash flow is moving, right? This is what this whole conversation is about, is understanding the full cycle and where you fit in. If you're that business that knows that you're gonna get a lot of money at a period of time and be able to pay down the money you use, then that's fine. Additional types of capital out there, CDFI loans, those are community development financial institutions. This is the next layer. If for some reason you're not ready today for the conventional loan, a CDFI is a really good opportunity. They're flexible on credit. They'll give different terms, and they might provide options to help you. They also have a lot of technical assistance. Venture capital, this is investors, folks that are interested in high growth companies or the potential. So that's usually for my clients that are more mature. They've already made certain amounts, let's say, 6 to 10 million, 5 to 10 million, and now you want to get to the next level. A lot of times a venture capital firm will come in and they'll see, an opportunity to help you grow to get to that next level. Angel investors are going to be for more of the companies that are not necessarily all the way at 5 million, more for the founders and folks getting started and kind of trying to ramp up. And then there's small business grants, right? I think we live in a place where there's a lot of opportunity with your local government, the business economic development centers. There's women association of women's business centers. There's a lot of places you can go online to look for grants. Hello Alice, Google grants. It needs to be something that you do on a regular basis. So if it's once a week, you go in and look for grants online, you can do that. It takes more time. You may want to hire someone. You may need more help there. So I know time is coming up really quick. SBA programs, a lot of times the SBA is going to facilitate small business growth. And so they don't lend funds. They partner with organizations and banks and credit unions and personal lenders to help you in terms of getting funding. And then what they do is guarantee that funder, whether it's a bank, a private lender, or whoever, they guarantee anywhere from 50% to 85% of the loan to that bank. So a lot of times this is good for startup businesses. This is good for businesses that maybe have high debt or over leverage, like we talked about. This is good to help with clients that might have to mitigate something, meaning you're over leveraged, you don't have much collateral, maybe your credit is not as good, maybe your, debt ratio is 1-to-1, right? You're not at that 1.2. So this is a really good time. A lot of time they'll give you more time to pay off the loan. They have lower down payments. And then they do charge a guarantee fee, but they'll roll those fees into the loan for you. So this is a good opportunity. And there's tons of SBA products. You go to sba.gov, you're going to find out who is their preferred providers. Chase is a preferred provider. M&T is one. They have private SBA funders. Everyone's different though. So you have to get approved through the lender first, meaning let's say it's Chase. We have our own requirements. Then we'll do SBA. M&T might have completely different requirements than Chase, right? And then they'll go SBA. a private lender might do something completely different from, Chase, M&T, and whoever, right? So it's about learning the individual lender and what their requirements are and how they work with SBA. So again, this is all about creating those relationships and asking the right questions. So I'll move on from here. Again, you have to be 15 million in revenue or less. They have all different types of products, from an SBA Express, which is 350,000, which is a quick loan. They have a 504 program, which is for larger capital loans. You can use it for commercial real estate. I'm gonna skip this. You can look into the book. It'll talk more about this. Again, the 7A program. So a lot of different opportunities here. I think we're gonna stop, and I want to kind of see if we have any questions. Again, a lot of this stuff you can find in the workbook, and going to the SBA website and pairing with your different SBA partner, because everyone is going to offer different products and have different requirements. And so I am a consultant with Chase. I am always looking to bring clients on. And so I would love, we're going to show my contact info. And, I'd love to see, if you found some value in this, please, if you could do a survey for us, that would be really good. And tell us how we did and let us know what you'd like to learn more about. And this also has my contact information. I am taking in new clients. The services I provide are complimentary. You don't need to be a Chase client to take advantage of my services. I do work with clients that have been in business for at least 2 years, um, and doing at least a minimal amount of revenue of 100K to up to 10 million in revenue. And I have some clients even as high as 20 million in revenue. And so again, we go through and do one-on-one approach to consultative services and figuring out what you need. We help you look at your financials to figure out where you are. We might help you peel back the layers on where there's area for opportunity, where there's business development, helping you with certifications, looking at just overall, do you have the right team in place, how you're navigating cash flow, are your profit margins where they need to be? And so just a lot of things that we can help you do. And so feel free to reach out. I'm happy to chat with anyone. And again, I do have some open spots to bring some clients in for the advisory services that we provide complimentary. And so I hope this was helpful, and please scan the QR code and take the survey. And I don't know if we have more time, I'm happy to take a few questions. But I don't know, I'll let the team tell me what their thoughts are.
Awesome, Christina. So actually, I do have a question. What is the best form of funding to seek when you don't have a P&L?
So I mean, I would need to know, does that mean you don't have a P&L and you don't have a business tax return? Because usually if you have a business tax return and it's not more than 6 months old, then that works. So for instance, if you're, obviously right now, if you're still using 2023 business tax returns, you would need a P&L. So if you're looking for a credit card, you wouldn't need a P&L necessarily for that, but it just kind of depends where you are. And if you don't have any business tax return, I'm not, you have to find maybe some of the SBA funding programs will look at your bank statements and things like that. But most conventional banks are going to want to see at the very least a business tax return. And, if you don't have a P&L, think about getting QuickBooks or something like that and using that to start, and there's tons of free courses on how to do, use QuickBooks, and then you should be able to generate an income statement or P&L, if both are the same, in order to get, get the information you need.
Thank
All right. Thank you, Amanda. We have time for one more question and then we'll go into close. Thanks to everyone who has stayed with us until the end. Christina, you are a wealth of knowledge, we can tell. And so, Amanda, if we have one more question, let's take one more question. And then for any other questions that come up, we'll be more than happy to respond back directly to those individuals.
Awesome. Thank you. I will say Christina has provided us with some resources already throughout her presentation. However, this just came up again. How can those facing social and economic challenges access capital and financial tools to build for their future?
So if you want to go to our website, chase.com/resources, we have a lot of information there in terms of looking. There's so much that we offer and that you can find there. And consulting with someone like myself, taking my information down, I can point you to some more resources. We have some, if you go to Advancing Black Pathways through Chase, we have some additional resources around personal, financial, health, as well as business health and growth. And so I think there's a lot of resources both online or if you want to interact in person. And if you're out of state, in the state, further away, you can go to chase.com/business consultant. And there you can, find a consultant in your region. If it's outside of this, this area. And so, yeah, a lot of resources there for you to access in terms of a lot of on-demand trainings that we offer. You can find trainings like the one I did online, as well as additional ones around cash flow, marketing, procurement, and a lot of, just there's online tools around worksheets and planning and, just if you want to start a website or you want to know how to come up with a income statement or a balance sheet. So there's so many resources within there that you can go through. And I mean, just kind of set yourself on your own kind of self-guided tour. And a lot of the workshops and information, they are self-guided. They have instructors that are guiding you through, that are on demand. And then, we're real live people that you can reach out to as well. And we're happy to help in any way. So I think there's a wealth of opportunities there.
Very good. Thank you so much, Christina. And thanks everyone for jumping on. As she indicated, there's a wealth of resources that are available. I know for me, you spent some time on slide 16, and I'm going to remind everyone that the recording and the workbook will be sent to every registrant within 24 hours after the webinar. So please, we will call your attention to that by sending that directly to your email box. Lastly, just a few things that we have from a Capital Readiness Program standpoint. I just want to announce 2 programs that are coming up. We have a Capital Readiness Accelerator that we will be launching next month in partnership with the University of Maryland Global Campus. We're very, very excited about this 6-week virtual executive education that will be centered around financial education and knowledge for our business owners. The deadline to apply is on Friday, May 3rd. You can leverage the QR code there to register that because we only have 20 seats available for this accelerator. So we invite you, if you're interested, to participate and apply for this particular accelerator that we are going to have next month. And then next in June, we're going to be hosting our Super Matchmaker Conference featuring the Capital Readiness Summit that is powered by the Minority Business Development Agency. This is going to be held on Monday, June 17th at Bowie State University. We're going to have corporate roundtables, networking opportunities, and of course, hot topic discussions by a renowned economist, Dr. Anirban Basu. And we're also going to be talking to a business owner that will be certain to provide great information to business owners in reference to how he grew and scaled his business, Mr. Torres Richardson. So you get your tickets now. The early bird special is available to you. Register by May 10th. And you'll save by May 15th, and you'll save $50 on your ticket. So that concludes our webinar this afternoon. Thank you so much, everyone, for coming out and joining us. And make sure that you visit our website at www.crmsdc.org. And you can find any upcoming events and information about our organization across the various different entities that we have, our Virginia MBDA Business Center, and also our operator, the Capital Region Minority Supplier Development Council. Thanks, everyone, and have a great afternoon.